Hey everybody, this is your main man Reg. Welcome to this episode of Give Yourself Enough Credit. We got our Java here. I'm gonna take a sip and I know that it's good. Today's gonna be a very good topic for you. How many people drive? How many people have cars? And usually if you do the other two, you probably have auto insurance, right? I want to give you a brief info segment about credit and auto insurance. So this may be eye opener for some, and it may be things that folks already know. Most auto insurance companies, in addition to a FICO credit score, many of them use their own credit-based score system to determine your premiums and how much that they want to insure you. So having that does have a lot to do with how high your insurance premiums are, and that's going to depend on what state that you're in. But we're going to get into it in a little more detail. Now, I'm going to use this little info board. Your insurance companies, they take a lot of things into consideration. First, you have your FICO credit score. And by the way, the credit score itself cannot be the only factor they use to determine suitability as far as being able to insure you. They also use your credit-based insurance score. The reason they use the FICO credit score is this is going to determine if you're going to be able to make your payments on time, or they look at the last 24 months and they can get a picture of that. Especially if there's something that if someone has had 90 days past due or whatever. So that is the main thing that they look at when it comes to this. Your credit-based insurance score, let me explain to you what that is. That is basically their ability to assess your likelihood to file an insurance claim or potentially a claim that could cost the company more to pay out versus the premiums that it collects. That's the difference between the two. Credit score, the history. Credit-based insurance score, basically your likelihood of being able to file a claim and for that insurance company to pay out more than it collects. That's the difference between the two. All right. As a general rule, there are a number of factors that they use to factor your credit score. Now, they cannot, in many states, it is prohibited to use the FICO credit score as the only factor to determine your suitability to get insurance from them. You have some states that your credit score isn't a factor at all. Examples of those are California, Hawaii, Massachusetts, and Michigan. But the overwhelming majority of the United States, they look at your credit score to determine suitability. Okay? The other things that they look at isn't just your credit score. They also look at your driving record. They look at where you live. They look at your demographics, and examples of those is they look at how old you are. So you probably notice the youngest age group, 17 to 21, may have a higher premium than someone that may be in the 35 to 44 age range. So that's one of the demographics they consider. They consider a person's gender. Don't know why they do that. Well, I know why, because we know, they're probably going to look at who's a safer driver. And marital status. There are a number of things that they consider in terms of demographics. The type of vehicle you're using, or the vehicle that you're wanting to insure, that makes all the difference in the world. Now, if it's something that is many years old and you buy it outright, then it may not cost as much to insure it. But if you're buying something relatively new or something that's within the last 10 years of the make and model, it may cost more to insure it. That's all that I can say on that one. Now, the FICO credit score and the credit-based insurance score, they may be different, but they tell the same indicators. Likely, if someone has a high credit score, they likely are going to have a high credit-based insurance score. And that'll give an insurance agent an indicator of whether they will insure you or not. But here's the ways if you want to get your credit score right and then get a higher credit-based insurance score. Pay your bills on time as agreed. That will help you no matter what you do. If you miss a payment, bring your account current as soon as possible. That will help you whether you do insurance or not. Decrease your credit utilization by paying down credit card debt. That will help you because if your score decreases because of credit card debt, they may not be able to see that on your credit report. But if the score is 500 versus someone else whose score might be like 650, it will be able to tell them certain things. So that is why it is important. Last but not least, check your credit report to ensure all the information is accurate and up to date. Because a lot of times people miss out on getting a better deal because the info on their credit report isn't as accurate as it should. There you have it, folks. Basically, we looked at credit and auto insurance and the correlation between the two. Just something to think about. When you get in the car, you open the door, you sit in the seat, you buckle that seatbelt, you turn the ignition on, you hear the purr of the engine, you check those mirrors. There's a saying. Every time those wheels turn, there's a cost. You have costs that you know about, and then there are hidden costs based on the choices that we knowingly and unknowingly make. This is your main man, Reg, and I need you to remember one thing. Give yourself enough credit. I love you guys. Take care of yourself and each other. Don't forget to like. Don't forget to subscribe. Don't forget to share. This will let me know that more of these need to be forthcoming. Thank you so much. God bless you.